Recently, BlackRock CEO Larry Fink published an article in the Financial Times titled, quote, "It's time for the second draft of globalization." It's safe to say that it took the world by storm. In that article, Larry acknowledged that globalization has created multiple problems, such as growing wealth inequality. But it goes without saying that the solutions he has in mind could make things much worse. And that's why today we're going to take a look at what exactly BlackRock is planning, how this could affect the markets, and what you can do to prepare. My name is Nick, and you're watching the Coin Bureau. I'll start by saying that nothing in this video is financial advice. It's educational content intended to inform you about BlackRock. If you appreciate this kind of education, then smash that like button, and if you want to make sure you get more videos like these, then subscribe to the channel and ping that bell as well. Now, let's begin with a summary of that article. Larry starts by revealing that he's been traveling the world over the last few months, meeting with the leaders of countries. Naturally, they've all had the same question. What's going to happen with the tariffs? Larry apparently didn't give a clear answer, but notes that the tariffs could result in, quote, supply shocks, spiraling inflation, economic slowdown. If this sounds familiar, that's because Larry was one of the Wall Street executives telling the mainstream media that the US economy was headed for a recession and could already be in one, and this was all back in April. To refresh your memory, April was when Trump's so-called Liberation Day tariffs were announced. Wall Street execs were not happy, and many, including JP Morgan CEO Jamie Dimon, were loudly speaking out. Another thing that Larry said back then was that the markets could crash by another 20%. But here we are, with stock indices hitting new all-time highs. Funnily enough, Larry doesn't address this in the article, at least not directly. All he says is that the effects of tariffs have been, quote, priced in, speculated to death, endlessly churned through headlines. Even so, Larry says this is just the short-term story. The long-term story is where things get interesting. Larry rightfully points out that Trump's tariffs are fundamentally a response to the inequalities caused by globalization over the last few decades. However, he argues that this kind of economic nationalism is not the cure for the sickness of relentless globalism. Instead, he argues for a, quote, blend, open markets with national goals and workers in mind. In other words, Larry is worried about economic nationalism because it'll make it harder for asset managers, like BlackRock, to move their money and influence around the world. And that's a problem as far as they're concerned, which is why they're framing the alternative as somehow being of benefit to us. Case in point, Larry goes on to give a definition of globalization that's a bit questionable. Quote, under globalization, money often chased returns around the world without necessarily benefiting the people back home. And this is questionable because it's not the flow of money that's created issues per se. It's the fact that labor was outsourced to the lowest cost jurisdictions to maximize profits as much as possible. With this questionable definition of globalization as his foundation, Larry then argues that the solution to the problems of globalization is to, quote, channel citizens' savings into local businesses and infrastructure. If this sounds familiar, that's because it's what the EU is trying to do too. But that's a topic for another time. And we actually have a video coming on that in the next few days, so make sure you subscribed and hit that bell. Anyways, Larry claims that by channeling the savings of citizens into local businesses and infrastructure, it's the locals who will ultimately benefit. And this is also debatable, as many countries and global corporations have begun importing cheap labor to suppress wages, and the most egregious example here being Canada, which is experiencing some of the lowest growth in GDP per capita as a result. But that's also a topic for another time.
It's the place to be when you're in need of amazing crypto deals and opportunities. It's got savings that you won't believe, like money off those pesky trading fees. It's the Coin Bureau Deals bonuses and discounts too. The Coin Bureau Deals page. We put these deals together just for you. Just for you.
Anyhow, this begs the question of how exactly BlackRock will convince citizens to channel their savings into local businesses and infrastructure. As it so happens, Larry lays out a step-by-step plan for us. Step 1 is to help more people become investors. And this is a bit odd because 60% of the people in the US and the EU are already investors, and chances are that this figure won't rise much higher. Whatever the case, Larry uses Japan as an example of how this can be incentivized. He notes that recent changes to Japan's tax laws incentivize more investment for retirement. And this is extremely important to note because retirement accounts are often managed by asset managers like BlackRock. Logically, this suggests that it's actually BlackRock that will be steering all of this capital as they see fit. Anyways, regarding Europe, Larry reiterates the same thing that EU elites like Ursula von der Leyen and Christine Lagarde have, and that is that Europeans save a lot more than Americans, but they're not investing this money in Europe. Larry blames this on a lack of unified capital markets, but even EU elites acknowledge that unified capital markets aren't necessarily the problem. Europeans simply consume less than Americans. But Larry seems to insist that it's just the lack of a unified capital market, as he's confident the proposed savings and investment union will do the trick in tricking more capital to flow into BlackRock's coffers. He even says, quote, "If I were an EU politician, that union would be my top priority." Since we're already on the topic, we might as well give you a spoiler as to what's in our upcoming video about this union. In theory, the proposed savings and investment union will just make it easier for Europeans, particularly retail investors, to invest in assets across the EU. Contrary to some viral claims, it will not force Europeans to invest in the dystopian stuff that the EU wants. But, as always, the devil is in the details. Maria Louise Albuquerque, the architect of the EU's proposed savings and investment union, revealed in a presentation back in April that part of the proposal will include auto-enrollment in pension funds across the EU. What this means is that all working Europeans will contribute to pension funds by default. In case you forgot, these pension funds are usually managed by asset managers like BlackRock. And in case you didn't know, BlackRock is on board with dystopian technologies such as a digital ID, which the EU is heavily pushing and needs investment for. In practice, then, the proposed savings and investment union will make it possible for the EU to subtly siphon money from working Europeans and allocate it to dystopian infrastructure projects it wants to fund, all with the help of BlackRock and co. The good news is that if the EU's Savings and Investment Union is approved, then it's likely to lead to a huge speculative wave, as EU politicians are explicitly looking to funnel retail capital into startups. And this is a recipe for rampant speculation, which could prove to be insanely profitable to those who get in early. The bad news is that BlackRock seems to want to deter this kind of speculation, since Larry explicitly warns that, quote, "unchecked financialization can fuel inequality." Perhaps we're reading too much into this, but it sounds like Larry doesn't want retail investors to get too involved in these startups, because it could create lots of volatility and wealth inequality as early investors reap most of the rewards. Now, by this point, you're probably wondering what exactly Larry and BlackRock's second draft of globalization really looks like. Besides getting more people to become investors and tweaking regulations to incentivize more domestic investment, Larry doesn't give much info, at least not in his article. To be blunt, it's not exactly that compelling or encouraging, especially when you recall that a lot of the global corporations and governments are bringing in cheap labor to do most of the infrastructure development that's expected to be funded with the savings of the citizens of the countries it's happening in. In this sense, the second draft of globalization looks almost exactly like the first, but the geography is different. Instead of outsourcing labor to where it can be done for the lowest cost, The lowest cost labor is now being imported. And this could very well be a consequence of the fact that labor costs are starting to rise in jurisdictions like China and even India, which were historically the destinations for outsourced labor. And this begs an even bigger question, though, and that's why there's so much of a focus on infrastructure development in the first place. And if you watched our video about Larry's letter to BlackRock's investors earlier this year, you'll probably already know the answer. Neither corporations nor governments have the capacity to provide the $68 trillion BlackRock estimates will be needed to be spent on infrastructure in the coming years. And this has corporations and governments looking at the savings of their consumers and citizens with dollar signs in their eyes. To put things into perspective, there are over $25 trillion of savings sitting in banks and money market funds in the US, and around $13 trillion of savings of this kind in the EU. So when Larry says we need to get more people invested in the markets, what he actually means is that all the people who are saving their money need to start giving it to BlackRock, so that it can allocate it in accordance with the ESG agenda and the UN's Sustainable Development Goals, or SDGs, which every country is supposed to hit in the coming decades. And FYI, the purpose of ESG is to meet the SDGs. And this isn't some kind of conspiracy theory either. Raj Rao, the president and CEO of Global Infrastructure Partners, or GIP, revealed in a recent interview that the first priority for infrastructure investment is the, quote, decarbonization of the global economy. And to bring you up to speed, BlackRock acquired GIP last year as part of its push to start investing in infrastructure globally. And if you watched our aforementioned video about Larry's letter to BlackRock's investors, you'll remember that BlackRock and GIP are acquiring everything from airports to ports around the world. Newsflash, but they are literally in the process of privatizing the entire world's infrastructure, which is truly scary.
That's scary. Yeah.
The only thing scarier than that are the even more dystopian ambitions of the jurisdictions like the EU, which do in fact want to use some of these passive flows they'll get from the Savings and Investment Union to militarize Europe in the coming years and decades. They also want everything to be green and digitally surveilled, so it looks like we'll have solar-powered tanks patrolling the streets of Europe in no time. Jokes aside, the key takeaway is that asset managers like BlackRock and jurisdictions like the EU are not only aligned, but actively working together to introduce investment schemes that basically trick people into investing into ideological projects that don't benefit them and could actually be harmful. And this begs the biggest question of all, and that's whether BlackRock and co. will succeed in implementing their second draft of globalization. Believe it or not, but the answer seems to be no, and that's just because most of the tens of trillions of dollars of savings that asset managers and governments have their eyes on aren't merely sitting in bank accounts. They're invested in other assets, typically government bonds. You see, many wealthy people around the world keep their savings in government bonds because they're essentially the safest place they can keep their money. Deposit insurance in most countries only goes up to a few $100,000, which puts any additional savings at risk. By contrast, you can rest assured that a government will pay back its bondholders. The only risk here is currency devaluation. And this is where things get truly fascinating. For those unfamiliar, bond yields are determined by bond prices, which are determined by supply and demand, just like any other asset. The lower the bond price, the higher the bond yield, and vice versa. Notably, bonds are always paid back in full when they mature, hence why the only risk is currency devaluation, in case you didn't already know. So, what happens if the tens of trillions of dollars currently invested in government bonds start to move into other assets? Obviously, bond yields will rise, and in turn, this will cause interest rates in the economy to rise. To be clear, we're not calling for a titanic sell-off of bonds. That's extremely unlikely. Instead, we're describing a scenario where there's a gradually less demand for bonds due to less savings. In this scenario, there would be two paradoxical effects. The first is that the rise in bond yields would make bonds even more attractive as a savings vehicle. And when given the choice between investing in a speculative green energy startup with zero cash flows and a bond yielding 7%, most savers would likely choose to stick to the bond. And this is guaranteed if the yield is substantially higher than inflation. The second paradoxical effect is that the rising bond yields would suppress economic activity, and this would lower the amount of savings as people start getting laid off and spending down their savings to survive. It will also result in many people selling out of all the infrastructure projects they were allocating to. And that reminds me, many of the things that BlackRock wants to spend people's savings on are illiquid assets, like bridges, for example, many of which won't be made for years. Aside from the fact that privatization of previously public services would be the only way to make these investments profitable, the capital invested would be locked for years. So people wouldn't be able to sell if they needed extra cash. And this is presumably the primary reason why there's tens of trillions of dollars sitting in various forms of low-yield savings accounts. After the inflationary shock of the pandemic, it's safe to assume that everyone is aware of how quickly their purchasing power is disappearing. And this means there's only one reason why they would continue to keep their money in savings, because it's there when they need it. The inherent illiquidity of the assets BlackRock wants people to invest their savings into could be the Achilles heel to the second draft of globalization, rather than its effects on the bond markets. Nobody in their right mind will agree to lock up their money for years when the world is becoming more uncertain and volatile by the day. And that's why BlackRock & Co. must sneak it through the back door with auto pension enrollment. But for the sake of entertainment, let's say that BlackRock & Co. succeed in rolling out their second draft of globalization. What would that mean for you and for the markets? I'll start by saying that this process is already underway. Larry revealed in a recent interview with Forbes that the reason why he's been traveling around the world in recent months is to meet with leaders to implement BlackRock's plan. And this is precisely why we're starting to see countries like the UK make tweaks around the margins that either incentivize people to save less or invest more. And it's also why we're starting to see countries like Italy introduce expanded work and immigration programs to bring in hundreds of thousands of laborers from low-income countries in the coming years. And this will also have two paradoxical effects. The first is that it will suppress wages in the industries where wages should be rising the fastest. And the second is that it will cause services-related inflation to rise, namely housing. If you stop and think, you realize that Globalization 2.0 is truly the same as Globalization 1.0, with workers getting the short end of the stick, except this time they're getting a front row seat, so to speak. There is a silver lining, though, and that's that the corporations on the receiving end of these capital and labor flows will be extremely profitable. Not only will they receive large sums of money from the savers being incentivized to invest in them directly via BlackRock, but they will also receive huge subsidies and incentives from governments. In case you missed the memo, the free market died a long time ago. In all seriousness, the fact of the matter is that the corporations that perform the best will no longer be those that provide the best products and services, but those that have the closest connections to institutions like BlackRock and the EU. You may not agree with their ideologies, but, as the saying goes, do you want to be right or do you want to make money? In a revamped version of globalization where you're now competing directly with foreigners for jobs in your area, the only way to get ahead is to play the game by its rules. And this means doing your best to work for the corporations with the closest connections to the elites and investing in the most radical and ideological ones. Ideally, you'll do this without losing yourself in the process. That will be the hard part. As grim as this all sounds, there is one ironic fact that will prevent this from lasting for long, and that's that it's unsustainable. If wages continue to be suppressed while inflation continues to rise, a change in leadership is inevitable, be it via a democratic process or by force. Contrary to BlackRock's claims, corporations are not short on cash either. They also have trillions of dollars on their balance sheets. In the end, they will probably be the ones that have to pay for all of this infrastructure development, and it will come in the form of higher wages to domestic labor in each country. With luck, these wage increases will be large enough to encourage more family formation and reverse the population declines we're now seeing in every country around the world. But that is yet another topic for another time. And by the way, you should know that public infrastructure isn't the only thing that BlackRock is trying to control. It's also trying to control crypto, even Bitcoin. And you can find out more about that by watching this video over here. And if you're not subscribed to the channel yet, you can do that right over here. This is me, Nick, signing off. Thank you guys very much for watching, and I'll see you again soon.